Last year, Michael Burry sent a letter to the board of GameStop, and it completely changed the narrative for the company and the stock. Immediately after that, the board decided to buy back most of their shares, and today we are on the brink of a short squeeze. Now GameStop got another very important letter, this time from Ryan Cohen. Ryan Cohen owns 10% of GameStop, which is more than what Michael Burry owns, which is about 3.5%. His message bears many similarities to what Michael Burry had to say, but there are also many differences. And the reaction of the market was very different because when Michael Burry sent his letter, the stock price of GameStop went up, but when Ryan Cohen sent his letter, the stock price of GameStop went down. So in this video, we are going to talk about this letter, what it means for the company, what it means for the leadership in the company, because he targeted the CEO and the board directly. So what it means for them and what it means for the stock long term. Before we talk about that, please make sure to smash the like button for the YouTube algorithm. If you are new to the channel, my name is Ishfaaq. I am a popular investor on eToro, where I manage assets for 200 people. So please subscribe and hit the notification bell so that you don't miss the coming videos. First, I want to talk about something that many of you asked me about. It's about the debt restructuring that GameStop recently had. Earlier this year, when there was the pandemic, the recession, we still have it, but now it's not so big. So when we had that, GameStop decided to restructure part of their debt. Most of their debt was to be repaid in March 2021, and they feared that they would not be able to repay it. So they restructured the debt. Half of it is now to be repaid in March 2023. But a few weeks ago, they decided that the debt that was due in March 2021, that with the amount of cash they have, which is about 725 million, they can repay 60% of it in December this year, so that they can start 2021 stronger financially. That was not enough to make Ryan Cohen happy about GameStop. Michael Burry, when he invested in GameStop, when he sent that letter, he was focusing more on the stock. That's why he told the management to buy back shares. He told them that there are things that are bad for their business, but he was focusing more about the stock. Because Michael Burry, he was acting as an activist investor. And activist investors, their main goal is to make the company return money to shareholders. But Ryan Cohen, he's not an activist investor here. He wants to change the business. And he made that clear when it was announced that he started investing in the company, that he wanted some influence. Ryan Cohen himself, he was able to become rich through Chewy, a company which he founded, an online company which was able to compete with Amazon. There are not many companies that were able to compete with Amazon. He was able to do it, and eventually he sold his company to PetSmart. By the way, before we continue, we need to mention that on the board of GameStop, there is the CEO of PetSmart and also the former CFO of PetSmart. So after selling his company to PetSmart, he used most of his money to buy shares of Apple, and he was the largest individual shareholder of Apple and shares of Wells Fargo. So he's a very concentrated investor. Now he wants to invest in GameStop with the intention, of course, to be able to compete with Amazon eventually. This is also something that we saw in the letter that Michael Burry wrote. In that letter, Michael Burry gave as an example that GameStop failed to buy Twitch and also GameStop, which were bought eventually by Amazon. If GameStop had bought those businesses, GameStop would still be the leader in online gaming. But that's not the case. Amazon is now the leader. It's because GameStop failed to buy these things, and GameStop was focusing instead on its physical stores. And this is the same problem that Ryan Cohen sees with GameStop today. He already talked to the board and the CEO privately, but there were not enough positive results. That's why he had to go public, and now everybody knows what he wants to do with GameStop, how he wants to change this business. So when this happens, usually, it means that the CEO and the board, now they should be scared about their job. Because when it was privately discussed, okay, they are not so scared anymore. But when it's public, now all the shareholders know what's happening. And we know that there are many activist investors involved with GameStop. There's not just Michael Burry. There is also Headshot Capital, Permit Capital, who added two of their men on the board of GameStop earlier this year. There was a proxy fight. So there may be another proxy fight to kick the CEO out, to change the board completely. This is possibilities we need to consider. So usually they will act. Now you may be asking yourself the question, if GameStop is doing so poorly, if everybody's complaining about it, Michael Burry, Ryan Cohen, why are they investing in GameStop? And Ryan Cohen, in his letter, he says why he's investing in GameStop. He said that there are many tailwinds that could profit the business of GameStop in the coming years. The gaming business is growing at a fast rate. People now want to play video games. I think there are more people playing FIFA 2021, I don't know, video games instead of playing actual football or soccer if you're American. And Ryan Cohen says that the gaming industry will grow from 175 billion US dollar, what it is today, to 218 billion US dollars in 3 years. So that's a big increase in the gaming industry. And GameStop is losing market share because the revenues of GameStop has been going down over these past years. Now you will tell me that because we are in the end of the console cycle, but Ryan Cohen rightly pointed out, he compared where GameStop is today, 2019 to 2011, so the end of another console cycle. So he compared exactly where we are in the console cycle to where we were in the last console cycle. So you cannot say that it's because of the ending of a console cycle, that's why sales are going down. It's not like this, because sales were much bigger in 2011. So this comparison is something that we need to acknowledge, that gaming industry was booming in all these years, it's still booming, but GameStop market shares is falling. So something has to change with GameStop if they want to be the market leader. And Ryan Cohen still believes that GameStop can be the market leader, because according to him, GameStop still has a very strong, powerful, valuable brand. If you look on the balance sheet of GameStop, especially the balance sheet from last year, you will see that there was a big impairment in goodwill and intangible assets. It's because of the falling stock price. But this is only in theory, this is only on paper. In reality, this is not true. GameStop still has an intangible asset. With 5,000 stores, they still have, people know about GameStop. People go to GameStop, people search about GameStop right now. People are searching on Google, buying PlayStation 5 at GameStop. So the brand value is still here, even if you cannot show it on the balance sheet because of accounting principles. But in reality, it is still here. And Ryan Cohen thinks that GameStop should use those intangible assets as a leverage for the overall business. And he believes they can do that if they go online and also closing many more stores. This is something that I have been talking for more than a year, that GameStop should close more stores. They have been closing stores, but not enough. 5,000 stores, that's still a lot. It was 7,000 a few years ago. Now 5,000, it's better, but still they have to close. Because you look at the income statement, most of their cost expenses comes from SG&A, selling, general and administrative costs. It's by operating these stores. And those stores, many of them are inefficient. According to Thinknum, for every GameStop store in the world, on average within 5 miles, there are 2 other stores, and 6.2 other GameStop stores within 10 miles. People don't go to malls anymore, but in every mall there is a GameStop. So they have to begin closing these stores and focus on the best performing ones, and then go online. This is what I have been saying for more than a year. This is the best way that GameStop can actually change their business. And I say that they are not closing enough stores. They have to fire people. You like it or not, they have to fire most of the employees, because these employees are just there. They are taking money without doing anything productive. They are just sitting there waiting for 1 or 2 customers to come a day. It's not good. It's better they find a better job which will be more fulfilling in their life. So GameStop has to take a drastic action. I know it may not look so good, but it is good for everybody, for the economy, for most people, and for the business also. I talk about all of that on my research partnership with much more details about the vast number of GameStop stores, how they are losing money, that SG&A cost. You can find all of this on my research partnership, and you will also have free access to my investing course for beginners with more than 150 lectures. If you want to try the partnership, you can have a 1-month free trial. Ryan Cohen gave the example of the stores in Europe and Australia which are losing a lot of money. The stores in Australia are not so profitable compared to the ones in the United States. And this is something I don't really understand, why everybody wants to have to do business in Australia. This is something I saw also with Kenworth Financial. Their margins in America are much bigger compared to Australia, but I don't understand why everybody wants to do business in Australia. They don't even have so many people, 25 million their population, 50 million kangaroos. I don't know why people want to do business there. So this is what GameStop needs to do. They need to sell those stores in Australia. They need to sell most of their stores in Europe. Focus only on America. Sell most of the stores in America. Focus on only some stores. 5,000 is too much. 2,000, maybe that's the right number. 3,000, 2,500, let's say. So they have to lower their number of stores by half. Because people are still interested in shopping at GameStop. People are still looking for GameStop online. You look on Google Trend, what people are searching for: PS5 Amazon versus PS5 GameStop. People are searching for PS5 GameStop more than PS5 Amazon. So people are still interested at shopping at GameStop. I saw some pictures about people. I saw that on Twitter that people are lining up to buy the new PlayStation 5 from GameStop in New York City. So people still want to shop at GameStop, but not in all the stores. In only some of the stores where there are many people who live there who wants to play video games. So they have to focus that. And I said that they need to change the stores also. This is something that Ryan Cohen mentioned, that GameStop needs to capitalize on the growth of esport, which is not something they are currently doing. GameStop have some experimental stores where people can try video games, can play tournaments. This is something they are trying, but it's not in all stores. It's only experimental. If they can't close the stores that don't work, then maybe more stores can try this experiment. And if it works, it works. And I hope and I think it is going to work, because the industry for esports is going to grow. And instead of playing in your home alone, maybe you can play among your friends if you still have friends. And even you compare the website of Amazon compared to Walmart or GameStop, you will see that GameStop website is designed for gamers. You search for PS5, I did the experiment even though they don't have it right now. I did the same search on Amazon, but on GameStop, I have other options. On Amazon, they are showing me something that is not even related. So it is better if you are shopping for video games to shop on the GameStop website. So they need to focus on things that are working. There is that rule, the 80-20 rule. Only 20% of the things that you do are actually contributing to 80% of the success. So do these things while you're wasting your time on the 80%. So I completely agree with what Ryan Cohen had to say in that letter. I did not agree fully with Michael Burry's letter, because in his letter, he said that GameStop should buy back shares. And I said that they should not buy so much shares. Instead, they should repay their debt. So they did both. So I'm quite happy with what happened. But with that letter from Ryan Cohen, I completely agree with his points that he made, how GameStop has to change. Ryan Cohen also mentioned that he's not going to fight for a board seat. So for the time being, he's just sending that letter. It's like a threat, because he singled out the CEO. He mentioned him by name, George Sherman. So he said to George Sherman that I talked to you, you're not doing what I told you to do, now you have to act. And he talked to the board. So they have to do something now, because their jobs are on the line here. They know it, that their jobs are on the line. Just because he said that he's not going to seek a board seat doesn't mean he's not going to do it in the future. If things do not change, he's going to do it. And we know, I talk about this, that the lawyer of Ryan Cohen is someone who is an expert on taking companies private and mergers, acquisition. So maybe he wants something more with GameStop, because he is a concentrated investor, a long-term concentrated investor. He sold his company, only bought 3 companies, shares in 3 companies: Apple, Wells Fargo, and GameStop. I don't think he's just here for the short term, for the short squeeze or anything. He's here for the long term with GameStop. So he will try his best to change GameStop. And he knows very well how to compete with Amazon online. He did it with Chewy, and he wants to bring the same thing to GameStop. And I believe he can do it. I hope he can do it. As for me as an investor, I have been investing in GameStop since last year. Things have got more and more interesting over the past few months. But I'm still having the same thesis on GameStop. Nothing changed. This letter came. I'm happy about it. I hope they are going to change things, make things better. The board, the CEO, the management, everybody there. But my thesis on GameStop, it did not change. I still think that with this console cycle, this is something Ryan Cohen said, that they should not just think about the next console cycle. They should think about the long term, something I like. In the beginning, when I was investing in GameStop, I was thinking about the next console cycle. I was investing because it was a sick or but stock that I will buy, the console cycle will come, then I will sell, take a big profit. But now, the more I'm thinking about it, is that the GameStop can actually change the business can change, can have a better future. And if this happens, then maybe I'm going to hold this for a longer period of time. So we'll see how things happen. But right now, my thesis on GameStop that there are two main catalysts that can propel the stock price higher: the new console cycle and also the short squeeze possibility, because more than 100% of shares outstanding are being shorted. It's still here. I still believe in this company, this stock, for at least the coming years. But over the long term, it all depends on what the management is going to do. So let me know in the comments, what do you think about this letter that Ryan Cohen sent to GameStop. Thank you for watching this video. Please like, subscribe and share. Please watch these two videos here if you have missed them. Have a nice day and goodbye.